What's going on? Welcome to Planet Podcast. Today, we're going to talk about SPX. If you don't know what SPX is, and you're a day trader, we're about to educate you. SPX will change your life. Maybe for the better, maybe for the worse. If you follow this video, you write down, and you stay disciplined, for the better is on the way. But before we get started with that, check the link below. If you want to trade on Webull, you need a cash account to do this, not a margin account. Sign up. They're going to give you some free stocks. Get started in there. You cannot trade SPX on Robinhood. If you are on Robinhood, you don't need to watch this video because you can't even participate. But you can trade it in other platforms such as Webull, TD Ameritrade, Thinkorswim, some other ones. Cash account is king. Also, this video is brought to you by TMF Apparel, Chem Block, Jim Kama, t-shirt for life, forever, what I'm wearing today. And without further ado, let's talk about SPX. What is SPX? SPX is the S&P 500. That's what we're trading here. We're trading options on it. This video is going to talk about something that I have been trading exclusively for the last 9 months, which is SPX 0 day to expiration, 0 DTE options contracts. Why would I want to do that? Because SPX provides the highest risk-to-reward ratio on trades that I have found, period, in the stock market. So we're going to take a little bit of time right now out of my night. We're going to talk about rules to trading SPX that you can apply to other stock options as well that could transition you from SPY, QQQ to something that can be far more lucrative. We're going to talk about some of the advantages, some of the disadvantages, reasons why people do touch SPX options, and reasons why they do not touch them, all of the above. But first, let's talk about one thing and one thing open. Like, subscribe, click the dinger, notifications to the channel, and let's go make you some money. Now, the first thing you're going to notice is we're using Webull. You can check out the link below, coupon code, get you some free stocks, get on Webull, get you a cash account so you're not restricted by pattern day trade rules. That way we can cycle these. This has a huge impact on something we're going to talk about later in the psychology of trading. But the first thing you're going to notice when you open up this is you're going to say, oh my God, those are expensive contracts. You are not wrong. They are expensive. At the money, SPX contracts, big money. When you talk about comparing them to other stocks like Microsoft or Apple or Rivian or whatever else you want to trade or SPY, right? Let's just compare it real quick to a SPY at the money contract here for Tuesday. We are at about $1.16, $1.12 spread, so $112 to $116 per contract for right about at the money. We click over to SPX, we're at $1,400 and $1,500. Now you're thinking, I don't have that kind of money to put into a single trade. And you don't need to. You don't need that kind of money. And that's where the first thing that we're going to talk about with SPX comes into play, which is patience. You gotta have patience. You can trade SPX with $500. You can trade SPX with $250. You can trade SPX with $1,000. Any size account can trade SPX, but you have to understand this. Whatever contract you buy will be worth absolutely nothing at the bell. Know that in your brain when you start trading this, because odds are that's going to come out correct. If you only got $250, you don't have enough to be in the money. Now, patience comes into play because as the day gets closer to the bell, these contracts decay and become significantly less. I can't pull up last week's contracts here, but at the bell, we're going to see these contracts be worth far less money than they are now. If this 4,000 call at close, the stock is under $4,000, that 1,400 is going to be worth zero. But if we do get an end of day move, like we saw right here on Friday, where we see a move from $39.96 to $4,000, that contract can easily go from $100 to $400 in a matter of 2 or 3 minutes. That's a 4x trade, 400%, just like that. You can also buy into them. Let's say we got a move. Friday was crazy. Let's take that. Preface this. That was a crazy move, end of day. But you got into a contract here, say $20 out the money, and we are $20 out the money, and we get this momentum play into the end of the day. That's where you're going to see the biggest moves on these plays. patience matters, because all day we saw a move. I'm just going to zoom out here to the 5-minute chart that we can see what we've got happening. We're going to go back here. We're going to see that we had a lot of consolidation throughout the day. And this right here will absolutely destroy your contract premium. If you hold through this, when you have definitely got some patience, you're going to hold through some serious anxiety, and you're going to really question your life choices as your contract goes from maybe $300 or $400 down to probably around $100 through this consolidation. And then as it rockets back up, you start to keep your premium back up. Patience matters because your entry matters. Have patience. Take the setup of the trade on a high probability setup. Now, I'm going to show this on my thinkorswim chart, because what is a high probability setup? Might be wondering, what does that mean? Well, we're going to take into a lot of factors when our trading here, and we're going to use a whole lot of technicals to determine whether or not we should buy a call or a put and what strike price we should take. This is where we take a lot of time to study the chart, to study the options chart, and know how they move. Because if we take a trade down here after a reversal and we catch the bottom, this is a high probability trade. 39.70. I was looking at 39.85 calls around this point, and they were sitting at right around the $3 mark, $2.85 to $3. I think maybe we can track that back here. Okay, that's a 39.90 call. You can see right here behind me where the bottom of it was 1.6. And this is a contract that I personally was in, so I'm very familiar with how it moved on Friday. And we can see that we spiked way up to the $6 mark. It's a 6X trade, down, consolidated. Now, I had 2 contracts at an average cost of $245 going into this. I bought one earlier in the day, averaged one down, held it, spiked up. I cut one on the spike, and then we rode this up. And through this consolidation period, I really didn't expect us to have such a breakout period, so I cut the second contract. Both of them green, both of them in profit. Now, as we see, once we had a starch breakout, this contract topped out at $14. So we're talking $245 average price to $1,400 per contract. If I'd have held both of them to the top, could have potentially turned $500 into $2,800 through that trade. So that is a low risk in terms of overall capital, high reward. I clearly stopped myself out, took that trade and washed it and looked for something else. Now, where I'm going to talk about the psychology of this trade is because I really want to emphasize this a lot. That sometimes you just need to cut the trade, even if it's $10 green, and look for another. That's the psychology we play here. We get anxious, we get tired of watching it, we get bored, we get nervous, we get excited. And all of these emotions when you're day trading, especially something as volatile as SPX. Now you're probably thinking, why I trade SPY, that move, I would have made all this money. You would have had to buy 5 contracts or more of SPY, leverage the same amount of money, and you never would have gotten that big of a move on SPY. It's the same movement in the market with the SPY contracts that the apprentice market. Keep that in mind. That's why we're on SPX. You only need to buy 1 contract, and it can go to the moon. It can go to the literal moon. So let's look back here. Let's talk about the psychology of this and where I kind of went wrong on Friday on my end. And that is that I was trading in the Discord with someone I trade with every day. And we both took the contract at 39.90. My entry was originally 3.0. We got a little bit of a spike up, and he said, I want to trade like you. I want to scalp like you. So you just tell me what you would do. Get a spike up, and I said, I will put a stop in at 310. So no matter what happens, the trade is green. It might only be $10. I might have leveraged 300 to make $10, which isn't great. In the scheme of day trading, not great. However, we saw buying power left, so we rinse and repeat. What would he do? He would hold it with a mental stop at 2.0. So he would risk $100 on the trade. I would want to risk almost no dollar. That's risk-free once we are green, which at my entry was a great entry, spiked up, we were at 340, 350, $50 profit on 300. That's okay. It's 15%, something like that. And then spikes up to 380. At that point is where I would put in my stop. So, all right, you know what? I'm going to move my stop up like 3-4. We're going to make $40. cool. If it holds and it runs, great. If not, whatever, and just bump our stop up. So he puts a stop in at 310. He gets stopped out. It comes down. I said, all right, Bo, I'm going to hold like you hold. He stopped out. He said, I would have held in. I would put my mental stop at like 2-0. Okay. So now the psychology that I have is I'm in this trade. I'm not looking for any other trades. All I'm doing is looking for an exit to this trade, right? I'm in it. I was green and now I'm red and I'm a little bit bummed. I'm a little bit butthurt and I'm holding on to it because I'm doing what he would do instead of what I would. Albeit, I don't like to hold multiple contracts at one time. So once that contract got wrecked a little bit in this pullback, I thought, man, you know what? And I typed it in the Discord several times. 38.85 call, that's the play. I'm in at 39.90. 38.85, that's the play at $3. At $3, that's the play. It was trading more than that. It was hot. 350, 40, 410. Got a better spike because it's closer to the money. We were trading over here around this, had to be, let's see, when was it? Probably in this area here, right? So we're trading around the 39.70, 39.71, 75 range. Vital range for SPX to hold. And I thought to myself, 39.85, that one go in the month, right? We cross over previous day's close. We were over that yesterday. Good chance probability. It's a higher probability of trade, better risk-reward ratio. But I'm holding the 39.90. And the psychology of this, to me, where I go wrong, is that I don't look for the other trade. I don't want to take another one because I'm already in this one, and this one isn't as good of a trade as I would have liked it to be. So I held on to it. And once it dipped down, it was down to like $2. I'm like, you know what, I'm going to average in, bring my average down, and then we get a spike up, and I can get out of the trade. Green, maybe not great, but we'll be out of it. Right? So that's what I did. I took that trade. In hindsight, what I normally would have done was closed it on the stop on the way down. Got stopped out, made $10. What did I do? Looked for another trade. I would have taken the 39.85 at the same fill price, 3M. That was the trade I want. And if we look at what the 39.85 closed at, was the 39.90 we saw hit $14, and 39.85 was like $20. So $300 to $2,000 on that trade. Higher probability of being in the money, safer trade, higher probability, or definitely had more time spent in the profit range after that bounce. And second that, why else would I take it? Well, because we bounced off this reversal zone and we held this, the EMA cloud turned green. We had a lot of technicals that pushed our trade in the right direction. So is it important to stick to your rules? Absolutely. Super important to stick to your rules. Because when you break your rules, that's when you start getting stuck in trades you don't want to be. So we need to have patience. We need to wait for the setup to have confirmation, right? We don't want to just buy it on a whim, on a gut feeling. We want to buy it on a confirmation, bounce off a reversal zone, a high probability of in the money contract. We want to make sure we have enough volume. We want to make sure that we have enough time to get to where we need to be. We need to look at all of these technicals in the market. We need to watch the other stocks in the market. Then we can make our entry and we have an exit plan. I want to make X amount of dollars, or I don't want to lose but X amount of dollars. Now let's say, what if my trade never goes green? What if I buy it and it just sits there and your entry point, you're buying the ass, you're already a little bit red off the jump. How much you want to lose? If you buy a contract at 3.0, how much you want to lose? Most people, most traders that I trade with are going to be willing to risk $50. So you put it in $300, stop at $250, let it run. As the contract moves up, there's a trailing stop, bumps your stop up. Sometimes you get wicked out, sometimes you don't. It's perfectly okay. Take care of your money. I cannot emphasize that enough. Have rules. Have an exit plan. Because as we can see on this thinkorswim chart here, we got some really nice spikes. $6, so you could have re-entered that again at 350 and sold again at 620 and entered again at 350 and sold again at 14. Could have done this several times. I cannot emphasize this enough. There are always going to be a better entry. It's a running joke in our Discord. There's always a better entry, right? It's a great entry, always a better one, right? We can buy it now. We can buy it later. Don't be impatient. Don't get stuck holding through lunch, low volume days. Don't be on the wrong end of it on a CPI day or a JPAL day or some volatile day And that brings us to the next thing about SPX. One of the most important things that you need to pay attention to. I cannot emphasize this enough at all. Let me make sure we can see this here. This number right here. This number right here is implied volatility. If we look at our chart, we can see the implied volatility here kind of increases as days go on. Some days higher, some days other. If we have a day in the market where there's any sort of news drop, implied volatility is going to be quite high. Right now we see it at 14.72, but not that high, right? That's pretty low. When this day opens on Tuesday, you're going to see this probably somewhere in the 25 to 35% range. Why is that important? Because as IV goes up, price of your contracts go up. Higher the IV, more expensive the contracts are, the implied volatility. Now, what happens after the news drops, after Powell speaks, after CPI comes out, after anything? From the beginning of the bell to the end of the day, we're going to get what's called IV crushed. You're going to get absolutely destroyed on that contract. IV sets the price of how well that contract holds up. The volatility. This contract is $15 now at 14%. At 30%, it's going to be almost 2 times that cost, $30 at the money. Also, if it opens at 30% and closes at 15%, it's also worth half. IV crush is real. Look at the IV on the day when you enter it, and look at the IV on the day when it's closing, and you're going to realize that it's going to absolutely get wrecked. That's what we call theta burn. Right? The theta on the day, the decay of the contract is 100%. The more the IV goes, the faster that thing gets decayed, the less money we have left. When it comes to trading SPX, you do not want to hold this sucker forever unless you are willing to let that thing go to absolutely zero. Zero. SPX is a great option for scalpers. It's a great option for end-of-the-day rodeos. You buy that sucker and take it for a ride. Most of my trades in SPX last just under a few minutes, and we get in and out, in and out, in and out. There are a few times where I will hold that sucker, but longer than that, based on a whole lot of technicals or some information that I do believe is going to be in the direction that I need to. Outside of that, we are not going to hang out for long. We're going to wait for the breakout. We're going to wait for the pullback. We're going to buy the pullback, ride the breakup up or down, whichever way it's going. So I need to be very clear on that. Now, I want to end this video here. We're going to do a series about day trading, about SPX, about IV crush, about delta, about technicals, about all of these things. So I want you to check out the other videos in the channel, but I'm going to try to keep them all under 20 minutes because it's hard to watch videos that are super long on stocks. We're also going to do some live training videos throughout this week. So make sure you follow along for those as well. And if you want to be a part of the Discord, I can put a link down there too. You can never leave a comment. We'll get you in the Discord. I do live trading on voice pretty much every day. So you can be a part of that as well. We talk about it. If we're in trades, if we're looking at trades, if we're taking trades, the technicals behind it, all that fun stuff as it pertains to 0DTE. Got a good group of guys that I've been trading with for the last better half of the year. And it's a whole lot of fun. So like the video, subscribe to the channel, follow me. We'll give you some more content. We're going to learn how to make more money in 2023.